Hey, what's up, everybody? Welcome to Renovate This. I was about to say welcome back, which I should have actually said, but it's been a long time. Just real quick, guys, we're starting this podcast up again. We started this podcast originally back in, my God, I think it was 2019 going into 2020. The idea was to create create a place for you guys to learn about renovation loans, learn about the ways to create value and to create wealth using real estate. And then, some things happened. We'll be real transparent in this show too, because I want to make sure that I kind of, talk to you guys about the nitty gritty, talk about the ins and outs. And I also want to expand upon what we talked about, in the past, not just about renovation loans, but, renovating, things in general. I'll tell you quickly, I've renovated my life. Things have changed there since we last talked back in, that 2018, 2019 timeframe. So real quick, for the people who've never been here before, or even for the people who have, I'm just going to take a little bit of a history of Renovate This. We're going to start there and then kind of like proceed into where we're looking to go. And then beyond where we're looking to go, I want to talk about the renovation loans and then kind of our structure, what we're going to look to do moving forward, and then ask for your guys' feedback too, because, part of this is that we're looking for, audience participation. Hopefully at some point we'll do some Q&A with the audience, and then we'll get some requests for people to come on for me to interview too, because all that's important as well. Real quick, the history of Renovate This. So as I said, we started this back in 2018 to 2019 after I went and sat in with Gary Vaynerchuk in his 4Ds, which is the daily digital deep dive. It was a great experience. I was able to learn a lot about how to use social in my business, which right now I haven't been doing, but we're going to be starting to get back into it. So Gary, a very inspirational person, somebody who really helped, mold where I was going with this. And Gary was a big help. So huge lift in getting this off the ground originally. And then let's be honest, 2019, as we started this, it rolled into COVID, and then the world kind of changed. And when that happened, it kind of affected the way we were doing business. Number one, I'll give you a little history of myself. Obviously, I'm in the mortgage business. I run a branch. Our company is HMA Mortgage, based out of Pittsburgh, Pennsylvania. I'm located in southern New Jersey in Marlton, and I've been doing renovation loans for a long time. Probably back to as early as 2009 was probably the first time I started to really dig into them, 2008, 2009, right when the Great Recession hit and we were having all these foreclosures, and I kind of saw, the writing on the wall. I saw some opportunity there that we were going to have a time frame in which there was going to be a lot of foreclosures, going to be a lot of opportunity. So, in starting that, I started building out a renovation division for my old mortgage company, again, because I saw an opportunity. And, I went to the owner of that then company, told him I wanted to build the best of the best when it came to the product. They got behind me. We built a great product. We built a great division. We got to about number 5, I think, in the nation at our high point. And then, then things went differently. I went in a different direction. And then fast forward to that 2018, 2019 time period. And, the goal was to bring you guys information, bring you this wealth of info on how to use renovation loans to build wealth, how to use it to build generational wealth. There's a lot of gurus who are out there right now. There's people all over, and hopefully a lot of those guys we're going to try to bring here to you guys here on this podcast. Because my intention is not to sit here and talk all the time, right? My goal is to bring you guys that are doing it on an everyday basis, not just guys that are, selling loans, or guys who are, selling a software product, or guys that are, out there just doing, the work. We want to bring it all together in one spot for you guys, so that you guys can understand how to do this stuff and do it the right way. There's some great opportunities out there. There's some really cool things we can do too. We're going to talk about. I have some guys that do ways to get business funding so that you can use that to kind of set yourself up for being able to do these loans and getting money that you might need. So we're going to talk about all kinds of things. We'll talk about credit. We'll talk about, the numbers. We'll talk about some of the instant equity opportunities that have arisen, utilizing these programs. So we're going to kind of dig in all different avenues. And as I mentioned before, feel free to make comments or reach out. I'm always willing to hear what somebody has to say. And if you got a request, please let us know, because we want to bring you the info about this stuff to help you guys do it and help you do it successfully. As I mentioned, I started in the business, doing these in 2008, 2009. Fast forward to that 2019 period, we've started a few different divisions, now doing the rental loans. And, one thing that I can tell you is that when we do it, we've done a really good job of helping clients to navigate these loans. But as I said, it's not just the loans. There's all kinds of different things you have to keep in mind. So we're gonna look at all of it. So why don't we start there? Let's talk a little bit about, some of the products that are out there, and then, some of the things that we want to, dig into. And again, these will all be, we'll dig in deeper on all of these topics and all of the things that we're doing as we move forward. But again, just for now, this being our first, podcast again, since we've done this in such a long period of time, let's dig in a little bit about the products. Let's talk about that type of stuff. And then what we'll do is, as we go forward, we'll dig in on different episodes specifically. And then we'll dig into talking to our guests as well, because that's super important. Our guests are going to bring you a wealth of info, and we want to make sure that we get the most out of those opportunities with them. So when we really talk about this, when I started doing these in 2008 and 2009, there was really only one product, and that was the FHA 203K program. FHA 203K program is still the flagship. It's the one that most people, if you even have heard of renovation loans, have heard of. There are definitely a lot of other options at this point, and we will investigate and go into each one of those. But let's just start with that one first. We have, let's list them out. So right now, at least in my world, we have the FHA 203K, both the limited and the full version. We also have the Fannie Mae HomeStyle renovation. We have the Freddie Mac Choice renovation. And then lastly, for us at our company, we have the VA Alterations or VA Reno product. So let's dig in a little bit on each of those, and we'll just kind of go through them. Now, real quick, there are other options out there, so I don't want you guys to think that that's all that there is. There's different products for fix and flip. There is a USDA renovation loan, which we can go into in greater detail at some point. There is, there's people that do those fix and flip loans where they'll use them for the fix piece, and then they'll use what's called a DSCR loan to do the takeout to keep that property as a rental. So there's a lot of different options out there, but let's stick to those main ones first that are mainly for the owner occupant, because those are the ones where we can really get started and they can really help us to grow this, and then also look at being able to do certain types of marketing gimmicks like the house hack. Have anybody ever heard of house hack? I'm going to throw that out there. House hacking is a great opportunity for you to build wealth, starting with your first couple properties. And it's a great stepping stone. So let's go back in and dig a little bit into the FHA piece. So on the FHA 203K, you got two versions. We'll call them two flavors, right? So we got two flavors. Our first one is the FHA 203K Limited. The Limited, it allows you to do cosmetic repairs and, small projects that are not going to go too long, right? That's the idea. It used to be limited at $35,000 in renovation. And then in November of last year, FHA finally made some adjustments to the program. And when they did, they took that maximum renovation budget on the limited up to $75,000, which was great, right? Because $35,000 just wasn't cutting it, number one. And in today's world, with the increase in material costs, with the increase in labor costs, with the increase in really everything that we deal with in today's world, just wasn't enough. So now going to $75,000, that can fit in a lot of things. So what do we see when it comes to the limiteds? you could be doing a septic system for, up to $30,000. And then you could also be doing a roof. You could also be doing flooring and painting, upgrading certain systems. So there's a lot that you can fit in that 75,000. The thing that's important is to keep it under 75,000. And also, it also means not doing any work that's considered structural. So if you're moving walls, that's fine as long as they're not load bearing. If you're doing any foundation work, that's not going to fit in under the limited because that's considered structural. So what we're really trying to find is those simple projects, the ones we can do, and the ones that are really good for first-time home buyers. Think about it. If you're a first-time home buyer, for a lot of our first-time home buyers, they're struggling to get a house, right? Number one, they're struggling to come up with the money for the down payment, right? Number two, they're also struggling at sometimes on how to qualify for things. So then throw in the idea of buying your first home and not having enough money to go buy your appliances, to do the renovations that you'd like to the house. What a better way to set yourself up than to use one of these renovation loans and put it into the loan itself, have it financed over the 30 years, and hopefully then be able to take advantage of the equity that will be created by doing these loans. So that can be huge for that first-time home buyer. The reason I like the limited is, number one, it does allow for you to be able to get things done pretty quickly. It does not require the use of a HUD consultant, which HUD consultants, you're going to hear me say this a million times, and we're going to have some HUD consultants on this call and on this podcast. HUD consultants are great to have. But again, if it's a minor project, similar, super easy, not really, nothing crazy, then there's really no need for have the consultant on it. We just really need some bids, and then to make sure that the contractors understand how they're getting paid and how the program works. And then we're off to the races. And that can be a really good way for somebody to get started using these loans. So when it comes to the limited, as I mentioned, some of the things that we can do, as I met, some of the benefits of doing the full 203K, which we'll talk about in a few minutes, are not able to be done during the limited. So the limited, just so you guys know, was also once called the streamline. So, so this is, it's not as easy as you think, because what happens with a lot of these is, we'll see somebody who will go in as a limited and they think it's only minor in nature. And then the appraiser comes out and does the appraisal after we've gotten it under, everything's moving along. We've got the bids. We send them to the appraiser. The appraiser then takes them and goes out and looks at the property. And then the appraiser comes back and he notices other things. And sometimes that's what happens with these limiteds. And it's also one of those reasons why we got to be real careful when we try to stick somebody in a limited. What we don't want to do is take somebody who's trying to do a limited and shove too much stuff in there that doesn't belong, right? Because that might just mean that it just should have been a full 203K from the beginning. So the limited is a great product. It's great to get things done, and it's a great way to do, to show customers and clients the best way to be able to renovate their home on the easier side when it's just cosmetic in nature. So that's the FHA 203K Limited, and that's a great product. I'm a huge fan of it. What I'm a bigger fan of is the 203K Full, and also known as the Consultant K. And the reason I like this one is because we start getting into the real cool projects. We start getting into the ones that are, really creating something, right? With the limited, you can't add square footage. You can't add a second level to a house. There's a lot of things you can't do, right? When it comes to doing the full 203K, or also known as the Consultant K, this is for projects that are considered structural in nature, go over the 75,000, or just tend to be a little bit more of a major or complex type project. In these scenarios, you are going to have what we have on board, which is the HUD consultant. HUD consultants are typically, people that used to be home inspectors, contractors, people with experience in the business. And the idea of having the consultant involved is he is there to help you guys through your project, and he's there to be the eyes and the ears for the lender. We don't come out to every project and look at them. It's impossible, right? We lend in 30 states. There's no chance that that's ever going to happen. So we've got to have some boots on the ground and some eyes and ears out there to let us know that a project is going the way it's supposed to go. So The consultant is a super important part of this project, and we deal with a lot of consultants all over the country. So we're going to bring some in on one of our upcoming podcasts. We might even bring in a few and maybe do like a little bit of a roundtable to talk to the different consultants and get some different views, because, different people in different areas are going to see different things. So that can be a big thing. I mean, we've got a lot of deals down in Texas, and I'm from New Jersey. So to be honest, when I see a project come in from Texas and there's a whole bunch of stuff going on down there when it comes to foundation issues, that's an issue that is targeted, or not targeted, but it is an issue that is native to the Texas area with some of the foundation issues that they have. I don't have them here in Jersey, but they are going on. So that'd be a good situation to show you guys what a consultant sees here in this area and what a consultant may see in, let's say, Texas, because those can be big differences. So we'll bring a consultant in, or a handful of consultants, and do a round table for you guys at some point. When it comes to the full 203K, though, what we want to really focus on is value adding items. What can we do to bring the most value in one of our renovation deals? And really the biggest value add at the end of the day is going to be adding square footage. And that's why a full K can be a great way to do that. We'll talk about some of the ways we've seen, properties increase in value utilizing these. Why don't we just jump into that real quick? So I'm going to use two examples, when it comes to doing the 203K, and ways that we've added value by adding square footage so that you guys can really see the impact of that. I had a client in North Jersey. At the time, his house was worth about $300,000. Now, this is a couple years ago, so if we were to put this in context, the numbers would be much higher. But I want to just give you the idea of like how we got there, and then we could talk a little bit maybe about how much the value might be different today. But the house was like $300,000 when he first approached me to do this deal, and we did what's called an add-a level. The add-a level is what I always kind of like just explain it as. It's like a ranch type house where we come in and we chop off the roof. Now, again, I'm really taking this down a notch and making it a lot easier than it is, but it's kind of like the basics. I want to give you a visual. We come in, we chop off the roof, we add on a second level, and we double that house in square footage. Okay. When we do that, people may have the bathroom, the master might be downstairs, the master bedroom might be downstairs. But when we double this house, a lot of times what we've seen is people will move the master bedroom from the downstairs to the upstairs along with the rest of the bedrooms, and then create this really awesome downstairs to allow them to be able to maximize their space for entertaining and family. And really that add a level can be a great way to really add a ton of value. So in particular project, we did this one, and at the time it was about a $200,000 project to do the add-a level. The property came back and it appraised for, I believe, around $700,000. So we created $200,000 plus in instant equity just by putting this on. Fast forward a couple years later, and we did another refi for this customer, and the value of the property was up to $1.3 million. So you can really see that by doing, and listen, some of these results, and I hate to be like the old disclaimer guy here, like some of these results are not going to, be indicative of future performance. I'm not selling a stock here, but I am telling you that there is an opportunity for people to make instant equity if you find the right property. This was one of them. This was a scenario in which we went from the house being worth $300,000 to being worth over $1.3 million. Now, that was over a couple year stretch, but it was because we added that square footage on to the top of the house to be able to go up that we were able to recognize that instant equity acquisition. So it can be huge. Now, listen, we see instant equity situations where we have customers who only make, $10,000. But if you're making any instant equity, isn't that better than just buying a house and only having the equity that you put down as the down payment? Sounds pretty smart to me. I would rather be in a situation where I buy a house, and yes, I got to put a certain amount of money down based upon the product. But if there's a way for me to build equity into it, so I'm already equity positive beyond my initial down payment, to me, that should be the way everybody thinks. And the wheels start turning and you see the dollar signs going, right? because what that can do for you is it can help you to become a move-up buyer sooner down the line. We'll talk more about that then. Let's get back into the product itself. So the 203K full has some really awesome opportunities. It's important to keep in mind when it comes to these loans that you are bound by the county loan limits. What I can do is I can put a link in the show notes here to an area where you can look up the local county limits for your area for the renovation loans to see how much of a renovation loan you can do. Keep in mind that it does go up based upon whether it's a 1 unit, 2 unit, 3 unit, or 4 unit. As you go up in units, the available loan limit size goes up as well. All right. So if we stay within those loan limits and we're doing the 203K, as I mentioned, you can do just about anything. You can add square footage, you can replace systems, you can do things like the septic, all the things you can do in the limited, you can also do in the full K. The difference is that you can do other things. As I said, adding on square footage by doing an add a level. You can do a bump off the back. You can basically, if the township allows you, you can take a property all the way down to the foundation and start new, and it still be considered a renovation loan versus a new construction, which can be huge. New construction has all kinds of additional costs that goes along with it. Impact fees to the township, all those type of things can be significant. So if you're able to do it as a renovation loan and reuse the existing foundation and even expand upon it, that can be a huge opportunity. Some of the other key components of the full 203K is that you can actually finance mortgage payments during the construction. So basically what that means is we build in a certain amount of months based upon what the HUD consultant says the house is going to be uninhabitable. So just closed one recently, and the consultant said that the house was going to be uninhabitable for 12 months. The program has a maximum of 12 months. Actually, you know what? I'm sorry. It was actually, it was agreed that the house was going to be uninhabitable for 10 months. So we only booked 10 months worth of payments into the renovation budget, but we could have gone to 12 had the HUD consultant allowed us. So with that being said, the cool part about that is during all of this, you can be living somewhere else. You live with family, you live with whoever, and you get this work done, and then you go into the house once it's done. You're not living through that renovation project, which is huge. So we really want to see if we can get that going for you, utilizing this. And again, this all comes down to, is the after repair value there so that you can build those numbers in? So we have to go through that as an exercise as well. So with the mortgage payments, that can be a great feature. The other side is again, we've also seen projects where you can go from a 1 unit to a 4 unit. You can go from a 4 unit to a 1 unit. So you can convert the existing property into what you would really like it to be. Now, it's important to keep in mind that when you go to do a project like that, you can't just automatically go and take a regular house and go and turn it from a 1 unit to a 4 unit. Meaning, if you live in a development, right? Let's just say you live in a development and all the houses in the development are all single families, but you see a property that's foreclosed on, or you see a property that you think would be a great opportunity to go do it, turn it into a multi-unit, most likely it's not going to be able to get approved by the township or the HOA, right? Because it's just not the norm for that area. So you've got to be able to look at properties where, it may be something you can convert, but is it going to be allowed in your area? And that's something to take into consideration. We do a lot of loans in the Philadelphia market, and that can be a great market where you can see the ability to do multi-unit, to create a multi-unit. Maybe not so much in southern New Jersey or in certain parts of Florida, like it might not be a multi-unit area. So again, it depends on the area, but the good part is it's something that can be done, and it can create value and opportunity for you as a homeowner. But I also look at people that are looking to do renovation loans as also investors, because even though you may not be buying it with the intent of renting it out today, a lot of our people are buying it with the intent of doing the house hacking method and eventually turning it into an investment of some sort. So I think that's huge. And I think we all got to decide what our mindset is and where we're going with things, but we'll come back to that in a bit. So let's talk more about the 203K, the full. So again, there's so much you can do with it. It's almost unlimited. Then we've converted churches into residential property. So there's a lot that you can do with the program. It's, as I mentioned, it's the flagship. There's a lot you can do. There's a lot that goes into it. So another thing that's important with 203Ks, contingency reserve. So let's talk a little bit about that. The contingency reserve is what we call our cost overrun bucket, basically. So you have a big project, and what we're going to do is with the contingency reserve, we're going to put anywhere from 10 to 20% of the renovation budget aside into a little bit of an escrow that we're going to sit there and we're not going to use unless there are cost overruns or we got to do a change order. There's all kinds of different reasons we may need to use it, but that fund is there for you guys as a consumer to have it in case there are things, because a lot of our borrowers, as we talked about a little while ago, you heard me say it, are not sitting in a great cash position. And especially after they close, they're probably not going to have a boatload of cash laying around to be able to do that renovation loan. So with that being said, it's important to keep in mind that escrow budget is there to protect you. And so 10% is the norm. We only require 15% if the property is uninhabited or the utilities are not on at the time of inspection. If the utilities aren't on, we're going to want to bump that contingency because, truth be told, you're going to have more high likelihood of issues once those utilities go on. So we want to put that bigger budget in there. And typically, the only time we really use that 20% is if it's a smaller project and I feel like there's not enough or the underwriter feels there's not enough money in it. That's number one. And then the other one would be if it's a historic home. A lot of times with historic homes, there's a lot of costs that we're not sure of. So there is that potential for us not to be able to have enough money in the budget, or because materials can be super expensive on this historic homes, we want to have a little bit of a bigger buffer on those deals. So that's your contingency reserve and kind of explains what it's there for. We talked about payments. We talked about the type of work you can do. Oh, let's talk about down payment and what everything looks like. So these loans, it's 3.5%, and this is for the limited version or the full K. And these are based on 3.5% of the purchase price plus the renovation budget. And so easy math, you buy a property and the purchase price is $100,000. You have a renovation budget of $100,000. Your down payment is going to be $7,000. Just down payment, not closing costs and everything else you need to close, just your down payment. So it's 3.5% of the purchase price and 3.5% of the renovation budget together to determine our down payment amount. Okay. And that can be a great opportunity for a first-time home buyer. So what are the other things that we can do in those scenarios? Number one, you can get up to 6% seller concession. A seller concession allows for the seller to contribute to your closing costs and your down payments and to your closing costs and to your prepaids. So as I mentioned in that scenario a few minutes ago, $7,000 is your down payment. That's the amount you have to bring, right? In an FHA transaction, you have to have 3.5% into the transaction of your own funds or be gifted from somebody else. Okay. But then, as I mentioned, you got to have your closing costs and your prepaids. But that's where the seller can come in. The seller can come in and do what is called a seller credit up to 6% of the purchase price. So in said scenario where we're buying a $100,000 property, they're doing a 6% seller concession. They could be giving us $6,000 back to cover closing costs and escrows, which are your taxes and your insurance. So that can be a great way to lower your out-of-pocket expense and only have to put down your down payment money. Okay. Also, that's a really important part too to keep in mind. The money that you are doing for your down payment doesn't even have to be yours. It can be somebody who is related to you that's going to gift you that down payment money. It can be somebody who has a close personal relationship. It can't be just somebody off the street, and it can't be borrowed funds. That's important to keep in mind. But if it's a family member, somebody we can create a relationship and show that we've spoken, that you guys have a relationship with that person, then we can use those funds for your down payment. So that can be a great way to do it. Again, it's a low down payment option, and you have the ability to have your seller contribute to help offset that cost as well. So we've seen a lot of deals where we see consumers come in and they're only bringing their 3.5% to the transaction, and the rest of it's being taken care of because the seller is doing a seller concession for the difference of the closing costs and the prepaids. So that's a great way to go through it. I want to make sure we get through all the products, so I'm going to kind of go a little bit faster here. Our next product is going to be the Fannie Mae HomeStyle and the Freddie Mac Choice. I want to put these two together because at the end of the day, they're both conventional products and they're pretty similar overall. So I may spout some things that goes to one product versus the other, but just know that they are both qualifiable under one or two of the conventional programs. And I'll happily run through that with you guys if anybody ever wants to talk about it in more detail. The conventional program is great. The conventional program does a lot of things that makes it a little bit easier than doing the 203K. So let's start there. On both of those programs, we have the ability to do as little as 3% down. So it's even less than an FHA. FHA is 3.5%. We can do 3% doing the conventional program because we're utilizing it with some of our other low down payment products for first-time home buyers. So those first-time home buyers could theoretically buy a renovation needed property and only need 3% down. Pretty cool. Conventional, some of the other things that I would consider to be benefits of the conventional program is that, number one, the mortgage insurance on a conventional loan is only on till you hit 80%. So, where FHA is lifetime on the mortgage insurance. So if you do stay in the loan on a conventional renovation loan, when you do hit 80%, we can take that the mortgage insurance off. So that can be a big benefit as well. So I really would say, hey, let's take a look at that program if it makes the most sense for you. Typically what we look at is those buyers who have a 680 or even a 700 and higher are going to make more sense to be in the conventional version of the programs versus the FHA. It's not a one size fits all. I will tell you that. I had a client that had a 622 credit score, and he would have been a perfect FHA candidate, but he was going over the FHA loan limits, so I couldn't even do it if I wanted to. So I had to go conventional, and it wasn't the most ideal situation for him. However, he was able to utilize and get what he needed. So ultimately, it was great to have an option for him. Otherwise, if we were just stuck based upon the FHA, we couldn't have gotten it done. So conventional does give you some benefits. And to that point, one of those benefits is being able to go to higher loan limits. As the standard on the conforming side in the conventional world, you can go and start your loan amount at the top right now is 802. Whereas in other areas of the country, I think it's 806 actually. I might be wrong about the number. I apologize off the top of my head. And the number, let's just say it's 806, which I believe it is. It's 806 is the maximum on the conforming side on the conventional loan. Whereas you may be in certain area, in a rural area, let's say in Texas, and the loan amount maximum is capped out at like $500,000. It's a big difference, right? So like you really need the conventional loan in that scenario. So that's a little bit about some of those things with the conventional side of things. The other side of conventional, which I find to be pretty cool, is conventional made some changes too. Conventional now will allow for as little as 5% down on 2 to 4 unit multi-unit properties. In the past, it required 25% down for 3 and 4 unit properties. Conventional finally saw an opportunity to fix that, and they lowered that down to 5%. That's pretty cool. And the cool part about doing these products too is if you buy one and you move into 1 unit and you renovate it and you get it ready and then you turn around and you get ready to go and do it again, you can do the same thing and you don't have to go and get rid of the program or refinance it out or anything. You can just go on and move on to the next one. And the reason I bring that up is because I forgot to mention this before with FHA. You can only have one FHA loan at one time. So if you do a 203K on your first one, the only way to go and rinse and repeat and do it again is to refinance you out of the FHA on that first one and then come back and then do another one. So it's just an extra step. So that's one of the benefits of doing the conventional version as well. Conventional also gives you some other flexibility you don't get with our regular ones. One might be the ability to have family members helping you out with the project. While we don't allow for any self-help, we do allow for family members to be the contractor on your transaction on the conventional side. Now, I'm going to put a caveat to this because everybody's going to be like, oh, I got Uncle Johnny or my dad or this one or that one. They'll do it for me and they'll do it for half the cost that a GC would do it for me. That's great. Well, and we'll go through this at some point on another show. But it's super important to recognize we do not allow for, even if it's your dad or it's Uncle Johnny or whoever, they still have to give us a retail dollar amount for the renovation that they're trying to accomplish. They cannot give us a not five finger, that's somebody stealing something. They can't give the family discount, right? We don't allow for that. The family discount, and the reason we don't allow for it, just so you understand, is because if something goes wrong with that family member or the project goes sideways or you have a falling out with your dad or you have a falling out with Uncle Johnny, we got to be able to replace that guy with somebody else that can do it for the same dollar amount. And if Uncle Johnny or your dad are giving you a 50% discount, I don't know if you're going to get another contractor to come in there and give you a 50% discount, right? They're going to want retail dollar amount. Where's that money going to come from? And as you can imagine, once that loan is closed, there's no going back to the well. There's a little bit of money in that contingency, but it's probably not enough to make up the difference. So it's important to keep in mind, even if we do allow for family members, we will do so, but they're going to be required to give us a retail dollar amount. Now, the good part is if we get to the end of the project and they did give you that 50% discount, now you've got a bunch of extra money sitting there. You could do a couple of things. Number one, we could allocate it to other projects, or we can take it and we can put it back against your principal and we can lower the principal unpaid balance. And in certain scenarios, we can recast it, which again, we could talk about some of these things in detail later. We can recast it and actually lower not only your principal balance, but we could also lower your monthly payment. That's on a case-by-case basis, but that is something that we can do. So those are some of your quick highlights. Oh, real quick on conventional. Some of the other things you can do on conventional. You want to put Bobby Flay's outdoor kitchen in? Go for it. It's a great idea. You want to put a full new pool in? You want to put a brand new $150,000 pool into the house that you're buying? Perfect. We can do that. We can do luxury items when it comes to conventional. FHA does not allow for what we deem luxury items. Okay. So that's something to keep in mind as well. The other great part is on the conventional versions, if you put down 20%, you can avoid mortgage insurance all around. So there are a lot of people that just vehemently against, paying mortgage insurance. And I get it. I totally understand. You don't want to pay it. Totally makes sense. The good news is with this program, by putting down 20%, you can still finance all the renovations and you get rid of not having to have that mortgage insurance on a monthly basis. So that could be a big savings too. So there's a lot of flexibility with the conventional program. We can dig into that more as we go. Lastly, I really just want to take a couple of minutes and talk about one of our other products, or really our last product, which is the VA Renovation or VA Alterations. I love this program. This is a great program for our veterans. So VA means Veterans Administration, and we can do an alterations program. Now, the interesting part about this program is VA itself has never come out with guidelines, where FHA has come out with their 203K guidelines. Conventional has brought out their guidelines for the choice and HomeStyle. VA Renovation is a lender-specific product on the guidelines that they want to do, right? VA doesn't say that you can do them, doesn't give you any real guidance on them. So really all the lenders make up their own determination as to what they're willing to do. And because the loans won't be insured until the work has been complete, most lenders want to see that you do a smaller budget. And in our instance, we will do it with $75,000 and less, but it's got to be cosmetic in nature only. Now, the good news to that is we can make some exceptions. So if you've got a borrower who's going to be $90,000 in, cosmetics, bring it. We'll talk about it. Let's see if we can make it work. There's a possibility we can. We also say that it's non-structural, but if it's something that maybe is teetering as to whether or not it's structural or not, or it's structural, but it's small enough and it's going to get done in a timely fashion, we may be open to it. Because again, we're not bound by the guidelines that are hard-coded in the VA. It's lender specific, so we can make exceptions to that. So bring them in. This can be a great opportunity for your veterans. And again, the stronger the file, the more likely we are going to be as far as making that, that exception. But it's definitely something that's possible. So bring it in. It's a great opportunity for veterans. We can go down to a 580 credit score. We can do 100% financing. It's just a great product for our veterans. And what a better way to put them into the property that they need and give them, the property in a much better setup by getting some of the work done up front. Some of the stuff we talked about, even some of the accessibility things that some of our disabled veterans need, ramps and accessibility in bathrooms. Like there's so many things that our veterans could possibly need. And what better thing to be able to do is offer that to them for the level of service that they put on their lives on the line to protect ours. So I'm a big believer in the VA renovation product, and we want to help our veterans. So, it's something that, VA can also be used because again, you can do house hacking as a VA person, right? Because you can use it and you can turn around, and sell it. You could rent it. You could refi it into conventional and then go use the VA eligibility again and again, go do it. So that's our product set. And I don't want to spend too much time on our first episode. I want to kind of give you guys a high level of the products just in general, just to kind of get you guys thinking about some of the things that you can do, right? But we're going to talk a lot on some upcoming other podcasts. One of them is going to be house hacking. I am a big believer in house hacking. I have a really good gentleman. I haven't even asked him yet if he wants to be on the podcast, but he really did a great job of utilizing, mortgages in general to do house hacking. And he's now turned it into something that he's now got a bunch of different properties, but he all started out by a house hack. And for people who don't know what a house hack is, it's basically just living in the house and then renting out either other units in the house or potentially rooms, and letting other people pay the mortgage for you. And then ultimately, after you've satisfied the requirement of the loan, like for FHA, living in it for a year, then you turn around and you either refinance it out, move on to the next one, or whatever it might be. And you utilize that house hack to get yourself started. It can be a great way to get this process going, and it can be a great way for you to start building that generational wealth. So we'll talk about a lot of these strategies and such as we go further down the line. But I really just wanted to get this first podcast off. But I'm a huge podcast person, and the one that I really am a huge fan of is the Ed Milet Show. I don't know if you guys have followed this one. Part of what I'd like to do as we wrap up our episodes is when we bring guests on, I want them to tell us, who their number one podcast that they listen to, or maybe even the top 3, and then tell us why. And for me, Ed Milet, it's all about growth. He's about, just growing as a person, growing as a business owner, growing in general. And I think Ed Milet really has created an unbelievable, following. And I think if we can do this podcast, even 1/10 of what he's done, I think we'll be helping you guys out, because my goal is not just to sit here and talk for 45 minutes. It's to provide you guys information so you can go out and use it and hopefully create wealth for yourself. There's nothing out there in this world that'll make you wealthier faster than by buying property and creating equity. So that is something that I am passionate about. And I want to use some of the stuff that I've learned from listening to Ed's podcasts to bring to you guys. That's a big one for me. Another podcast that's a huge one for me is going to be Bigger Pockets. So if you guys have not listened to Bigger Pockets is an unbelievably great place to start. I believe back in 2011, I joined Bigger Pockets as a pro member, and I probably listened to well over, I think they're in number 300-ish or so, or maybe even more. I don't know. I think I probably listened to over 300 podcasts on that, as part of their stuff that they put out there. It's a great place to start. Lots of great information. And, just want to share with you guys things that have helped me, because I'm an investor too. I'm not just a guy that lends the money. I'm not just a guy who involves myself in doing the projects and understands what's going on. I'm an investor too. So when I'm giving you guys information as we go through this whole thing, I want you to understand I'm giving it to you guys from a place that I've been to. So with that being said, this is longer than I thought I was going to go on my first one with me just sitting here and chatting myself. But it's been great to have you guys here. I'm excited to bring this thing to you guys as we move forward. I'm excited to show you some of the things that I've learned through the years. And I'm also excited to bring you some of the guests that I've got ready to go that were excited to talk about things with you as well. So enjoy the rest of your week. I really look forward to seeing you guys again. If you can, like, share, and subscribe. And we'll see you back here soon. And renovate this.